Hey guys, my name is Henry and in this video I'm going to cover covered call ETFs. Covered call ETFs and high income ETFs, they have been very popular, and recently I have tons of people in my community asking about them. So, I always want to bring you the facts, the data, and everything is back tested. And I'm going to show you exactly whether these covered call high income ETFs are worth it or not. I'm going to cover ETFs such as JEPI or JEPQ, and I'm going to tell you whether they are worth your money or not. And the answer might surprise you. And personally, I'm not touching these ETFs, and I'm going to show you what are the better alternatives to covered call high income ETFs. All right, guys, let's get into it. Okay, first, what are these covered call ETFs? These covered call ETFs have been gaining a lot of popularity because they promise to pay very high income. They often distribute dividends every single month, and many of them have a dividend yield of over 10%. That's amazing, right? But the thing is, if you don't know where the income is coming from, maybe you are the income. And in most of these ETFs, for them to pay such high income, there is NAV decay. The net asset value of those ETFs go down over time. So in most cases, even in the most recent covered call ETFs and high income ETFs that have newer strategies and more efficient strategies, they are still paying that income from the NAV, from the value, the fund itself, okay? And how do they supposedly achieve these high yields? Well, they do covered calls, so they hold the stocks in the index, S&P 500, for example. If they are tracking the S&P 500, they hold the 500 stocks in the S&P 500. At the same time, they are selling call options or index call options or ELNs, other products like synthetic products. And the problem with these is that it comes at a cost. It's like buying insurance. Insurance, it's not for free, right? So they will guarantee a certain income, but at the same time, they will cap the upside, and over prolonged periods of time, these ETFs are not good for investors. And I'm going to show you in this video the exact numbers and the better options to these ETFs. Now, one very important thing when it comes to investing is that there is no one size fits all, right, when it comes to investing. So I'm telling you here that covered call ETFs are maybe come at high cost. I'm going to show you better alternatives, but it doesn't mean that you need to follow these, right? You need to analyze your own situation and see if for you covered call ETFs and high income ETFs make sense or not. But to be honest, for someone who doesn't need exactly predictable monthly income, I will generally consider total return and capital gains as something more meaningful than a high income that comes at the cost of the ETF not growing at all. Okay, so let's jump on the screen, and the first ETF I have here to share with you is JEPI, the JP Morgan Equity Premium Income ETF. And this ETF, the benchmark, it's the SPYI, the S&P 500. And I know that we have here a lot of numbers, but don't worry, I'll go through the numbers with you. And what we see here is the first column is the total cash return. So the dividend distribution plus capital appreciation of JEPI, okay? And what we see here is like we have 2021, 20%, 2022, 3.7%. Well, you can look at the numbers. And at the entire period, you had a 72% return. Return on capital gains plus the dividend distribution, the income distribution. And then we have SPYI, right? The simple S&P 500 ETF that is, I think at the moment, one of the biggest ETFs in the world. It tracks the S&P 500 companies. And as you can see, pretty much every year, except for 2022, had a better return than the JEPI, right? And at the end of the period, 165% versus 72%, right? So by looking at these numbers, you can already see that SPYI seems to have more advantage than JEPI pretty much every year except 2022, because indeed, covered call ETFs can give you some downside protection. So in years where you have a bear market, potentially these high income covered call ETFs can give you some downside protection and protect you a little bit more from volatility. But then that again comes at a kind of high cost. The third column that we see here, JEPI DRIP return, considers DRIP simply means a dividend reinvestment plan, is what if you just receive these dividends, okay, you receive this income and automatically reinvest back into the fund? Would it still underperform or outperform? And the reality is that still with the DRIP plan, reinvesting the dividends in every year except 2022, you'll still lose money when compared to SPY. You have here the DRIP edge that I calculated, and for every year except 22, it's always negative, sometimes double-digit negative, and at the end of this 6.5 year period, you'll have returned 83% less with JEPI when compared to S&P 500. Okay, so now you are probably asking, so what's a better option to these ETFs? I'm glad you asked, because the better option is, instead of holding one of these covered call ETFs, you just buy the S&P 500. If the JEPI in this case is tracking the S&P 500, what if you just hold SPY or VOO and every month you sell a little bit, or every year you sell a little bit, you sell the equivalent that you'd receive from these covered call ETFs, right? So these covered call ETFs are trying to pay 5, 7, 10% dividend yield. You can just sell a little bit of your SPY and generate the same income for you. So let's jump here back on the chart. So this column here, what shows index plus sell edge, shows like how much, what will be the advantage percentually if you just follow this strategy of holding the index ETF, the simple index ETF, such as the SPY, and selling a little bit every month or every year to achieve the same income. And as you can see, every year you still have more advantage. 7% in 2021, 2022 you'll have, actually it will be disadvantage, you'll lose 14%. But for all the other years you have 15% advantage, 12%, 9%, 5%, and at the end of the entire period you have a 61% advantage. So instead of having this covered call ETF, JEPI, you just have SPY, and you sell every month or every year a little bit of your SPY to generate that income. Still, at the end of this period, you'll have 61% more money than you'll have with the covered call ETF. So after looking at these, do you think it makes any sense to have these covered call ETFs? Well, if you want to have a covered call ETF just because you want to have the peace of mind and you don't want to press the sell button of your SPY of other ETFs, then okay, it's okay. But that comes at a very high cost. Again, we have here 6.5 years period, and at the end of the 6.5 years period, if you just hold SPY and sell a little bit to generate the same income that you will get to JEPI, you still have 61% more money in your portfolio than you'll have with JEPI. Okay, what about the other ETFs? I analyzed a total of like 6 or 7. Let's look at JEPQ. JEPQ is also the JP Morgan NASDAQ Equity Premium Income ETF. Same story, same story. So this one tracks the NASDAQ, and this is also very evident when you look at the historical chart, right? Historical chart, you see that JEPQ, this is including dividends, by the way, JEPQ is up 85%, QQQ is up 116%. And again, very evident that every year the cash return, the real return of JEPQ and the real return of the QQQ are very different. And every single year, as you can compare here, the first and second column, the return of the QQQ is always much, much better than the return of JEPQ in every single case. 2023, JEPQ returned 34%, including the cash dividends, the income, right? While the QQQ returned 54%. For 2024, JEPQ returned 22%, and NASDAQ QQQ 25%. For 2025, JEPQ returned 13%, while QQQ returned 20%. You get the idea. Over the total period, JEPQ returned 61%, and the QQQ returned 114%. Almost double, okay? Again, you will compare here. If you are watching the video, you can look at the screen and see that the DRIP, the dividend reinvestment plan, will still give the QQQ, the simple QQQ, a big win. And looking at the column that I like the most, index plus sell edge, in every single year, if you just sell a little bit of your QQQ, equivalent to get the income that you will get from JEPQ, at the end of the period, you still have 25% more money than you'll have by having JEPQ. Okay, let's look at another very popular one. This one, it's we have many years of history. We are talking about QYLD, the Global X NASDAQ 100 Covered Call ETF. And let me maximize here so that you can see the entire chart. And again, same story. In every single year, just holding QQQ will outperform holding QYLD. Okay, except for we have here actually many years of history from 2014 until 2026. There is only one single year when we look at index plus sell edge. There is only one single year, which is 2022, where holding QYLD will be better than holding QQQ. And at the end of this entire period, the edge of just holding QQQ when compared to QYLD will be almost 400%, as you can see in the chart. 397%, okay? So it comes at a huge cost, huge cost, okay? If you have held this covered call ETF, QYLD, because you want the so-called dividend and the high income, you would lose so much money, okay? You would have so much lower returns. I would really stay away from this. And the chart is very evident. Again, you look at this chart. Come on, guys, just look at the chart. This chart includes the dividends paid. QQQ 809%, while QYLD 180%. Okay, it's very different, and it shows that definitely not worth it to hold QYLD. Okay, let's look at others. There are many more recent high-income ETFs that people say, oh, what about these new high-income ETFs? They maybe pay a bit more. They have different strategies. They are not exactly the same. They don't have the same decay. And they might be a bit more efficient, but still cannot beat the index, the QQQ, okay? Again, you cannot have your cake and eat it too. And these ETFs are promising you that you can have your cake and eat it too. One of these ETFs is the NEOS NASDAQ 100 High Income ETF, QQQI. And again, same story. You can look at the numbers. The cash return of QQQI compared to QQQ always underperforms. Of course, they started in 2025 or so we have 1.5 years period. But again, having the index, the QQQ in this case, will still give you an edge. You can still sell part of your QQQ to generate income, and you still have more money at the end of the day. Now, okay, guys, just one thing that you might be asking about. What about the tax implications? In this video, of course, I'm not looking at the tax implications. I know that some of these dividends, high-income dividend ETFs, might give you some tax advantages. I'm not a tax specialist. I live in Hong Kong, where taxes are very different from you guys. Most of my audience is in the United States. And for me, personally, in Hong Kong, I pay 30% dividend tax, okay? I pay this withholding dividend tax, 30%. It's crazy. But I pay 0 capital gain tax. So in my situation, I really prefer much more capital appreciation rather than receiving dividends. So depending on the country where you are, maybe your dividend tax is so much lower than capital gain tax that you just prefer to receive dividends, or maybe these ETFs give you some kind of advantage in terms of tax treatments. Anyway, if you want to know more about how these taxes work, you can join my Henrik Wealth Academy, because inside the academy I make this indicator available and it gives you the exact tax treatment. And by the way, inside my Henrik Wealth Academy, you have my ETF course, you have my stock market course. The ETF course is a 5-hour long course talking about ETFs, everything you need to know about ETFs and leverage ETFs. And you can join the academy, 7-day free trial. You can cancel the trial anytime. If you like, you can stay. Check the link in the description. Join the academy. I'd love to see you there. Okay, let's look at the next ETF. We have XYLD, the global S&P 500 covered call ETF. And, well, I think you can already kind of guess the story. This ETF has a very long history too. Started in 2014, and since 2014 until now, there was only one single year, again, where this ETF outperformed the S&P 500, SPY in this case, and since then, compared to the S&P 500, this ETF would be much, much lower. In fact, if you just manage to do the strategy of holding SPY and selling a little bit every month, you would be better off by 200%. Then we have SPYI, NEO's S&P 500 High Income ETF, which started in 2023. And again, this ETF is slightly better because the NAV decay is not as bad, but still, again, SPY beats every single day this covered call ETF, this high income ETF. And at the end of this 4.5 or 3.5 year period, you'll still be better off by holding the index and selling a little bit by 20%. Okay, so by now, I think you already understand why I don't like much these high income ETFs. They come at a cost, and if I just hold SPY or QQQ and sell a little bit when I need, or I sell according to the 4% rule, which is 4% rule basically says that if you sell 4% of your portfolio, S&P 500 or NASDAQ, you most likely can continue to do that for the next 30 years and not go bankrupt, okay? That's a formula that is very popular within the FIRE community, Financial Independence Retire Early, which I'm a big fan of. Now, covered call ETFs can be still useful if you want the very automatic cash flow. You don't want to press the sell button because it's psychologically hard. So you want that income coming to your account without thinking about it. Okay, then go ahead and get the covered call ETFs. They also reduce volatility, okay? They have some downside protection, some. That's why in 2022, they perform better, okay? But they also cap your upside. One of the biggest advantages of investing in the stock market is that your upside is uncapped. You can compound and win more and more and more and have the compounding effect. In these ETFs, they break the compounding effect because when you sell covered calls, you are capping your upside. So that's one of the reasons why I don't like. But again, there is less behavioral pressure when it comes to sell. And again, if you are retired and you are interested purely in income and you want some very low risk strategies, maybe this can be something that you can think about. Now, what I prefer is full participation in the market. SPY, QQQ, full participation. I control when I sell, when I press the sell button, and I'm not dependent on these asset value decay that these covered call ETFs have. Because as you know, I'm always interested in bringing you the real facts, the real data. I'm not sponsored by anyone. I just want to bring you the best strategies for long-term wealth building, okay? This is what I do also every day in my Henrik Wealth Academy. Check the link in the description. They have a 7-day free trial. If you want to cancel the trial, no questions asked. But there, every day, I share my ETF strategies, my stock market strategies. We have an 80% win rate, okay? 80% win rate that you can fully audit because I have the trade alerts that I post in the community. And we have a trade alert tracker. 80% win rate. Like if I tell you that there is an 80% win rate, I think you should definitely check it out. And why do I have this 80% win rate? Because I look at the facts, I look at the math, I look at the fundamentals when it comes to investing in stocks, and I buy and hold for the long term. I'm not a short-term trader, I'm a long-term investor. All right, guys, if you enjoyed this video, give it a like and subscribe, and I'll see you soon. Bye.